This is the moment most people will look back on and say they ignored it. Because what you're about to hear completely reframes the XRP price conversation and exposes why $2 is psychologically engineered noise, while a much larger endgame quietly takes shape behind the scenes. And if you've been wondering why certain interviews, comments, and timing feel strangely coordinated, stay with me, because this new interview changes everything. Welcome back to XRP Insider Network. This is your home for the signals, patterns, and narratives the mainstream refuses to connect. So if you value staying ahead of the crowd, smash the like button, subscribe, turn on notifications, and let's get straight into it. Because this is not hype, this is not hopium, and this is absolutely not financial advice. This is analysis, speculation, clearly labeled as speculation, and pattern recognition based on public statements, historical behavior, and incentive structures. Now, the interview in question didn't come with flashing lights or dramatic headlines, but that's exactly why it matters. Because when people who are close to institutional plumbing speak calmly, confidently, and without price obsession, that's when the real clues leak out. And the first bombshell is this subtle but deliberate reframing of XRP not as a crypto investment, but as infrastructure. And that single shift is the foundation for everything else, because infrastructure does not get valued like a meme. It gets valued like a system component that must scale with usage, liquidity demand, and systemic risk mitigation. In the interview, the language repeatedly circled around phrases like liquidity corridors, settlement efficiency, capital release, and cross-border friction reduction. And nowhere did they talk about retail price targets or short-term speculation, which immediately tells you who the real audience is. And it's not Twitter traders, it's institutions, treasuries, and payment networks. Here's where the $2 narrative starts to look laughably small, because $2 is a retail psychological anchor, not a utility-derived valuation. And anchors are tools used to keep expectations contained while infrastructure is being built, tested, and quietly integrated. Think about this for a second. If XRP were genuinely only meant to be a $2 or $3 asset, there would be no need for the level of regulatory engagement, legal warfare, and enterprise partnerships that have unfolded over the past several years. None of it would make sense, because you don't fight that hard for a marginal outcome. The interview hinted, without explicitly stating, that liquidity depth is the primary constraint for real adoption, and this is where the price surge plan becomes visible. Because liquidity depth and price are inseparable. Higher price allows larger value transfers with less slippage, and less slippage is non-negotiable for institutions moving billions, not millions. This is why the conversation around XRP's price is fundamentally backward in retail circles. People ask, how high can it go, when the real question institutions ask is, how high does it need to go to function safely at scale? And those are two very different questions with very different answers. Now let's talk about the $100 XRP speculation, because this is where things get emotionally charged. And again, this is speculative, not a promise, not a prediction, but an exploration of what certain system requirements would imply if fully realized. When you hear someone in an interview calmly dismissing low price ranges and instead emphasizing throughput, reliability, and global reach, you're being told indirectly that price suppression narratives are temporary, not permanent. Consider the math nobody likes to do. Global cross-border payments move tens of trillions annually, and even capturing a fraction of that flow requires liquidity pools that are orders of magnitude larger than today's crypto markets, and those pools cannot exist at low prices without absurd token velocity and instability. The interview also touched on regulatory clarity as a when, not if, scenario, which aligns with the idea that the legal phase was a gating mechanism, not a deterrent, and once gates open, price discovery changes character entirely. This is why $2 is nothing, not emotionally, but mechanically, because $2 does not satisfy the design requirements implied by the interview's framing. Another overlooked moment was the emphasis on interoperability rather than dominance, suggesting XRP's role is not to replace everything, but to connect everything, and connectors derive value from volume and trust, not hype cycles. Trust, once established at institutional levels, compresses risk premiums, and compressed risk premiums invite scale, and scale demands price appreciation to maintain equilibrium. Here's the part that should really make you pause. The interview subtly acknowledged that retail often sees price last, not first, meaning that by the time price becomes obvious, positioning is already done, corridors are already live, and narratives shift overnight from "why would this ever pump?" to "how did we miss this?" If you're finding value in this breakdown so far, take a second to like the video and comment where you think XRP's real utility flaw might be, because community insight often surfaces angles mainstream analysis misses. Now let's address the emotional resistance people have to high XRP numbers, because it's not logical, it's psychological conditioning. Years of sideways action train people to self-censor expectations. But infrastructure timelines are not linear. They're punctuated by step changes, and interviews like this are often precursors to those steps. The price surge plan, if we can call it that, isn't a pump. It's a transition from speculative containment to functional necessity, and necessity does not ask permission from sentiment. The interview's calm tone is what makes it powerful. No promises, no hype, just quiet confidence that the system is moving towards something much larger than most are prepared for. And historically, those are the moments that matter most. As we move into the second half, we're going to connect this interview to past examples of infrastructure assets repricing. Suddenly, explore why 100 XRP isn't as crazy as it sounds under certain conditions, and outline what signals would confirm that this transition is actually underway rather than theoretical. So don't go anywhere, because this is where the story gets very uncomfortable for anyone still anchored to $2. To understand why the idea of a triple-digit XRP price keeps resurfacing among serious analysts rather than hype channels, you have to detach from crypto thinking and step into infrastructure valuation thinking, because the interview quietly reinforced a principle markets have demonstrated repeatedly, which is that once a system becomes necessary, price discovery accelerates violently and without regard for past ranges. Look at historical analogues, not in crypto, but in network infrastructure like bandwidth, energy distribution rights, or even critical software layers. Early pricing appears flat and disappointing until adoption crosses a threshold, and then repricing happens faster than most participants can react. The interview hinted at phased adoption, where initial corridors test reliability under limited volume, followed by expansion. Once confidence is established, and this is where price comes in as a shock variable rather than a gradual climb. If XRP is required to settle larger and larger value flows without friction, the system must either increase token supply, which it cannot, or increase token value, which it can. And that simple constraint is what fuels the $100 conversation, not fantasy, but structural necessity under certain adoption scenarios. Now, does that mean $100 is guaranteed, imminent, or inevitable? Absolutely not. And anyone telling you that is selling certainty where none exists. But what the interview does is make it intellectually dishonest to dismiss the possibility outright, because the design logic doesn't cap price at retail comfort levels. Another key detail was the repeated emphasis on resilience during stress events. And stress events are where liquidity assets reveal their true valuation, because panic exposes weak systems and rewards those that hold. And if XRP is positioned as a neutral bridge during volatility, its demand could spike precisely when everything else is failing. This is also why regulatory clarity matters so much, because institutions cannot rely on assets that may be frozen, challenged, or politically compromised during crises. And the interview's confidence on this front suggests behind-the-scenes alignment that retail won't see until it's too late to reposition cheaply. What most people miss is that price suppression narratives serve a function during build-out phases. They keep attention low, volatility manageable, and accumulation quiet. But once utility flips from experimental to operational, suppression narratives collapse under real demand. Imagine corridors settling billions daily and needing deeper pools overnight. Price doesn't negotiate in that environment. It adjusts. This is why $2 is nothing, because $2 represents a market still debating if, while higher valuations represent a market responding to now. If you're still here, make sure you're subscribed, because these transition windows don't announce themselves twice, and when sentiment flips, content shifts from analysis to regret very quickly. As for the new interview, its real value wasn't any single quote, but the alignment of tone, timing, and framing, all pointing to a system approaching readiness rather than speculation. And that's the most dangerous phase for anyone waiting for obvious confirmation. The final takeaway is simple but uncomfortable. XRP's future price, whether it's $10, $50, $100, or something else entirely, will not be decided by what feels reasonable today, but by what is required tomorrow. And requirement is a far more powerful force than opinion. Stay grounded, stay skeptical, label speculation as speculation, but don't let psychological anchors blind you to structural signals, because markets don't reward comfort, they reward preparedness. And this entire discussion is about recognizing that preparation phase before it becomes headline news.